concepts material. We are going to do this little reading on the liquidity conundrum, a little topic review on the liquidity conundrum. And I think this is a great reading. So what we're actually going to do is we're going to go back and say, well, how did we get into the mess that occurred in 2007, 8, 9? And this gives us an economic explanation of what was going on. Now, what we're actually doing is we're going back to a very old economic theory. And what we see some dots in time. And this particular theory happens to weave through those dots very well. Now, whether that means this is truth or not, I don't know. But it does make for a good story nonetheless. So what we're going to do is start by redefining what we mean by liquidity, and then think about how that overlays the idea or concept of speculation, and then apply that to the housing markets in the U.S. So if we think of liquidity, well, if you just bring up the notion of liquidity and we're talking about the economy, then everyone immediately jumps to the idea that we're talking about monetary aggregates, right? So, M1, M2, those types of things. We talked about all that at level 1. We don't need to bring it out here. It's not going to be a big deal, but it's basically the liquidity definition that is determined by the central bank. So the central bank can either add money to the money supply, or they can take money out of the money supply. That is, they can push liquidity into the economy or take liquidity out of the economy. Well, that's the traditional view, and that's not what we're talking about here, all right? So it's when you see the words liquidity and you're talking about the economy, that's probably what you should think about if you're taking a CFA exam. But for this particular topic review, you need to forget that. So here we're going to look at liquidity as an appetite for risk. So in other words, if we become more risk averse, we're going to change where we're keeping our money. So liquidity is viewed as a function of risk aversion here. So the less risk averse we are, the more liquidity we're going to provide to what we're ultimately going to call shadow banks. And a shadow bank, I think that's a confusing definition for many candidates. And just think of that as, well, we've got banks, that's the traditional bank, and then we have other places where we would put our money. Well, it's the money that we're putting into these shadow banks that define our level of risk aversion and therefore are also going to impact what's going on with liquidity in the economy. So the traditional bank versus the shadow banks. Well, of course, traditional banks, we all know what these are because they say bank out front, right? So this is the first national bank of whatever, and they're very heavily regulated. Well, one of the more heavily regulated industries anywhere in the world. They're provided with liquidity in the United States via the Fed's discount window. So if they need money, then the Fed is by definition the lender of last resort, and they can go to the discount money and the Federal Reserve will lend them money. Okay? And I think perhaps most importantly for our discussion here is they have federal deposit insurance. And what that means is if you are an investor and you have deposits that are below the credit or deposit insurance maximum, which traditionally has been $100,000. That's had some variability in it in the United States in recent years. But nonetheless, if you are below the deposit insurance limit, then you really don't care whether or not there's a financial crisis going on. So if you say, well, I've got my money in this bank, and if it goes under, that's okay. I have less than whatever the insured maximum is, and the government will make good on that deposit because I have federal deposit insurance. So there's no incentive for me to withdraw funds if I think there is some sort of upheaval or crisis in the future. Now, if you contrast that with a shadow bank, and you have to go with the definition here because this isn't standard terminology, but nonetheless, we have some money that we keep in the bank, right? The traditional bank, but we have other money that we put in other places, hedge funds, REITs, we invest them in CDOs and those types of things. We're trying to get a little higher return. We're also taking greater risk. These sources typically, or the way we're going to define it here, don't have access to the guaranteed lending associated with the Fed. So they take more risks and they have no regulatory capital. The result is there is an incentive for investors to withdraw their funds when risk increases. So if you were an investor in a REIT or a hedge fund, or you own CDOs, and you go back to 2007 and you were looking at the market and you were going, I think systematic risk is generally increased in this market, well, what you would do is you would withdraw your funds from that market, okay, or from that shadow bank, and then go to the traditional banking system or something else where you weren't subject to that same risk. Now, let's talk about the mortgage market. So we'll start out with a discussion of the 228 adjustable rate subprime mortgages. Now, what this means, okay, a 228 means that you are borrowing money. You add those two things together and you get 30, right? So the typical or the traditional mortgage instrument in the United States for financing of an individual family residence is a 30-year fixed rate mortgage. You could also get a 15-year fixed rate mortgage, and then there are the adjustable rate mortgages. Well, this 228 means that you have 30 years of financing, but you're going to have a 2-year rate locked in, and then it's going to adjust thereafter. Okay, when we talk about the subprime mortgages, essentially what this means is that the borrower was putting no money down. All right, so they didn't have to have any equity investment in this property. So the property cost $500,000. They would get a $500,000 loan. Interest payments in the end essentially became optional. That is, they didn't even have, the borrower did not have to have enough cash flow to cover the full amount of the interest expense. We called those negative amortization loans. So the borrower would make a payment each month, and that payment would be maybe $1,000, but the interest expense would be $2,000, which means what? You borrowed $500,000, and the amount that you owed when you sold the house was going up by $1,000 a month. So if you own the house for 60 months, then you would have to, you borrowed $500,000, you'd have to pay back $560,000. And if you take that and you add the fact that the interest rate on this was a 2-year teaser rate. What does that mean? It means it was artificially low. So you're getting someone who can borrow, a lot of money. They don't have to put any money down. They get a 2% teaser rate to begin with. Well, if you are, if you're getting a $100,000 loan at 2% for the next 2 years, that means that you only have to pay $2,000 a year, and we may not have even been making them pay all of that, right? Because they may have been a negative amortization loan. So this was what our mortgage markets got to in 2007, and we're going to talk about, we're going to take this and contrast it with the evolution of the mortgage instruments through time very quickly. That makes it sound like it's going to be a long process. And what we're going to end up saying is, well, yeah, no wonder we had a problem here, all right? So what we're actually going to do here is look at Minsky's financial instability hypothesis. Basically, this is a 3-step process towards instability or towards a meltdown or whatever you want to call it. So we're going to start out, and when the markets are stable, we're going to have what's called a hedge unit. Then as we have investors and both sides of the contract, the lenders and borrowers are going to start taking on more risk. We're going to move to a speculative unit, and finally we're going to move into a Ponzi unit. And the point of this financial instability hypothesis is that once we get to the Ponzi unit, a meltdown is essentially inevitable. So there's going to have to be problems with this in the economy. We don't go through the full-blown theory here, but we'll show the progression anyway. So here's the notion. So going back to, before we had all the legislative mandate and executive orders to increase lending in underserved areas and those types of things, the typical instrument used to finance a single-family residence in the United States was a levered investment, okay, but it was hedged and stable because it was hedged against the earnings generating capacity of the borrower. So the borrower had sufficient earning generating capacity to pay back both interest and principal. So it was a 30-year fixed rate loan. You would make payments of $2,000 a month. That represented less than 33% of your monthly income. So you could make your payments. That was both principal and interest. You do that every month for 30 years, and then the mortgage is paid off. Homeowners in the U.S. historically avoided debt, and they paid off the mortgages much sooner. The average life of the mortgage in the United States was only 7 years. Now, of course, some of that is because homeowners moved, but the instruments weren't outstanding for 30 years. So that's the hedge unit. You've got someone who's making sufficient income. They're buying a home that they can afford. The interest rate is fixed so that as long as there's no illness or massive upheaval in their earnings stream, then they're going to be able to pay back the loan. Now, let's take that one step further into the risk spectrum, and we're going to go to a speculative unit. And this is going to be riskier than the hedge unit. For the mortgage market, what that means is the borrower purchases an asset backed by enough cash flow to pay back interest, but not principal. So this is where we got the interest-only loans, and we're saying, well, okay, if you can buy this house for $500,000, if you can make the interest payments on it, then we'll give you a loan that you just make interest payments, probably have a balloon payment at the end, that sort of stuff. This is less stable as the borrower is speculating in two things. One, that interest rates won't rise, because if interest rates rise, then that's going to stress their income and make them so they can't service the debt, and that property values will not decline. So if property values stay the same or go up, then if you get in trouble, you could always sell the property and get out of it. But if property values decline, then of course, interest rates are up, property values are down. Well, that's the sort of the nightmare here. But you had to have a fair amount of upheaval for this to cause systematic problems, right? Now move to the Ponzi unit, which is basically the 228 that we talked about a few slides ago. This is the riskiest of the stages. Here, the asset cash flow, in this case, when we talk about asset cash flow, that's language from the instability hypothesis, but what we're talking about here is the income generating capacity of the borrower is not enough to even cover the interest expense. Okay, so they can't pay any principal, they can't even pay the interest. That's where we got this negative amortization mortgage. So you would get a loan that would give you financing for a couple of years at a very low interest rate. You wouldn't even be paying all of the interest expense. So if you borrowed $500,000, you got a few years of financing, you would owe more than $500,000 when the loan came due at the end of this initial lock-in period. So here what we have is we have borrowers speculating that the property will rise in value. It's not enough for it to not decline. Here, property values have to rise in order for them to be able to cover this. Otherwise, they're not going to be able to get out of the loan. They're going to owe more than the property's worth. And the point of the reading is that by 2006, the marginal unit of debt, the increase in the borrowing in the United States mortgage market was exactly this Ponzi unit, this 228 negative amortization loan, and people were making bets that property values were going to rise and they were going to reap windfalls from that. But you didn't have to have any qualifications. You didn't have to have a down payment. You didn't have to have enough income. So obviously we had lots of people end up abusing this, and the borrowers and the lenders are equally culpable in that, if you ask me. So what this represents, when we talk about these subprime mortgages, especially if you think of it with negative amortization, teaser rates, all those types of things, what we were really doing was we were giving the borrower a free at-the-money call option. So remember, with a call option, if the value goes up, you exercise your option, you buy the asset at the exercise price, and you sell it in the market at whatever the market price is. But if the market price of the underlying asset goes down, you walk away. That's what a call option is. So you exercise when it's in the money, you walk away when it's out of the money. So here, the borrower effectively got a free at-the-money call. So you could buy the house for whatever it was selling for today. We'll call that $500,000. And you get this negative amortization loan, so it's basically like paying rent. So you weren't really servicing the debt. You weren't even paying the full amount of the interest expense. So no down payment. Okay, and the full interest payments were optional, and the borrower's position would be valuable if home prices rose. So we think in California, 2003, 4, 5, well, housing prices were going up by 20%. So the value of the house goes up by $100,000 in a year. You bought it, you didn't put anything down, you sell it, you bring out $100,000, pay off a little negative amortization, and you think that's great and you want to do it again, and everybody else wants to do it, and that's how we attract people in to the Ponzi scheme. And that is, quite frankly, how we got into the mess that we had following that period where we had gone into these 228 mortgages. So the point of this little reading is just to show the progression from the hedge to the speculation unit to the Ponzi unit. As you get both sides of the contract willing to take on more and more risk, well, once you get to the Ponzi unit, that's going to attract all of the piranhas, and we're going to see the market's going to end up bubbling, and then, of course, ultimately, that bubble is going to have to collapse. So that is a quick run through the financial instability hypothesis as it would relate to the housing markets in the United States.